podium, but I guess I'm just going to stand right here. Um, so a little bit more of a maybe behind the scenes kind of story to this, but recently one of my close friends had a 20-year-old daughter that suddenly passed away in her sleep. I attended this small memorial to kind of celebrate her life. Her memorial had probably 1,000 or more pictures of her and her life. And, you know, as you probably heard this in the past, pictures worth 1,000 words. So based on what I saw, she had lived a beautiful life. She was a scholar, an athlete, a motorcycle enthusiast, a motocross rider. She loved her family, enjoyed the outdoors, and she was brave. She was brave by living life to the fullest and not letting anything tell her she couldn't do something or wasn't strong enough to do something. The moral of this inspirational message is really be brave in living life. Don't let things pass you by. Be brave to reach out and grab an opportunity and do something that you have always wanted to, and take a little chance. Also, be brave in creating opportunities, as you don't know when the good Lord will call you home. So,
Very good.
Amen.
Amen.
Yes,
Yes.
appreciate it.
Thank you.
Health and welfare. Are there any updates on the health and safety of Rotarians? Everybody's doing good.
No, thankfully.
Yes. Next slide. Are there guests to be recognized today?
Yes. My brother, Peter Marsh, who is an investment advisor with LPL.
Okay.
Welcome.
Well, welcome, Peter.
Mhm.
Thank you. Thanks for being here. All right. Very good.
President Ray,
Yes.
I don't see that Fred is signed on to the meeting,
No.
but I've got a tray full of slides here. If you don't mind, I'll run them.
Okay, go right ahead.
Yeah, we were anticipating Fred's return here today, but he must be still out in the world. So one of the things I wanted to let people know is as a past president, I still have access to a lot of the Rotary International spy network and cameras and things like that. We've made a few sightings of Fred out there, and I just thought I'd share those with some of the things that I found anyway. And the first one is, you probably know Fred's a pretty avid Lions football fan, and we did catch him at one of the games. Seemingly a little disappointed in the team's performance. He still was keeping social distance and still trying to enjoy the game.
He looks better.
So, you know, Fred's a big car guy too, and that apparently he had a little time to do a little bit of racing this summer, and caught him relaxing between laps here, and looks pretty confident in his abilities, and I'm not quite sure how he did on this one, but I'm sure he did pretty well. He's also taken some time to do a little contemplating, soul searching, and we caught up with him in a pose of contemplation here, and I just thought it was nice the way he was able to match up his Firebird's hat with his robe. So I think that he takes
no
his,
rotary
He's
pin
very
there.
flexible.
no rotary pin, so we might have to fine him for that. Also, he joined up a few of his friends, kind of, traveling the world and finding new adventures. And so this was kind of a picture of him on his camel mount, exploring the Arabian desert. And of course, that Fred had always enjoyed doing our lottery, and he really misses that. And so he kind of took that same passion to the internet now, and he's offered his own sports book betting. If you have a chance, you might want to try to dial him up and make some mobile betting. And of course, Fred is a big a dog lover, pet lover, and he had a chance to show off one of his pets here recently at a dog show here in New York. Very intense. I'm not quite sure how they did on that one.
Who's the lady on the right?
Yeah, well, they're pretty intense people there, so they're serious about their business. The other thing is, I know Elon Musk. I don't know how he did this, but he struck up some relationship with Elon Musk and was able to hitch a ride on one of the latest shuttle missions here.
Will they be coming back?
Well,
That's a one-way.
yes, a one-way trip. And they did get a few shots, of course, when he was up in space. He's up there with all of his buddies. So yeah, we haven't heard from him back yet, so while he's been gone, he's been exploring some of his musical passions as well, and he joined what they call one of these K-pop groups here. And I don't know if you can pick him out or not, but you can see the group here. So this is RM, Jin, Suga, J-Hope, Jimin, V, and Fred. So one last thing. I don't know how he was able to swing this one, but I'm a little bit jealous myself. But he was able to find himself a way out to Oak Island, and has become one of the explorers out there. They still haven't quite found anything. They found a lot of little shiny objects, but no real treasure. So I'm hoping he'll stay there for a little bit longer till they uncover something, and we'll see when he gets back. But I was going to welcome him back, but he's not here. So welcome back.
That is hilarious, George.
Yeah, I did see Fred downtown this week. We were both shooting the Capitol members at the same time, and he was in good spirits. Told him it was good to see him.
Good.
Okay, it's time for the program. Kearsley Street Week. Flint Rotary welcomes Nick Godleski, Dartman Dave, on the screen left, and the whole panel. Welcome. And Nick, you are front and center.
All right. Can you guys hear me okay?
Sure can.
Yes.
All right.
Yes.
If you didn't see it at the beginning, just so you're not distracted. Yes, I lost a fight with the ice. I slipped on the ice last Friday and smacked my face on a pile of wood.
Oh.
So, but it's all good. I made it here. And so everybody's fine. We're good. So thank you, Mr. President. I would like to start with a little bit of Kearsley Street Week history. Kearsley Street Week number 1 was 1994. Bill Clinton was our president. The Dow Jones was at 3,800 points. Kearsley Street Week number 8 was George W. Bush's first Kearsley Street Week. The Dow was at 10,800 at that point. Obama's first year was 2009. The Dow was at 8,000. Trump came in at 2017. In 2017 with the Dow at 19,800. That was Kearsley Street Week number 24. The Dow closed out 2020 at 30,606, which was up 7.2%. In contrast to the S&P 500, which was up 16%, which is a broader indicator of the stock market as a whole. The first Rotary Club, today, the Dow is up about 0.8% year to date at this minute. The Dow first closed above 1,000 points in 1972. It took another 15 years to simply reach 2,000 points. The first Rotary Club of Flint's Kearsley Street Week was held on January 25th, 1994, with past Rotary president George Carpenter as host. In 1994, the 10-year treasury yield reached almost 8%. And right now it's just under 1%, which in inflation adjusted return or real yield, that equates to a negative 1.3%. That's the yield minus 2.3% inflation. Also 1994, the year Major League Baseball had its 232-day strike, causing the 94 season to be canceled. And back then, a gallon of gas was $1.06. This is the 28th Kearsley Street Week program. Last year at this time, or at the end of 2019, things were on the up and up. We had an extremely strong 2019. All indications were that this would continue. Even those pesky economists from the Economic Forum, who are almost always negative about the future of the economy, said that they had good expectations of 2020. I think this is the year where I probably don't need to go back and do a recap of the year 2020. It was just simply strange. But I will a little bit. I just want to remind people, aside from just all things COVID, what was going on during the market during that year, last year. The Dow was at 29,000 during our Kearsley Street Week meeting last year. Then it bottomed out on March 23rd, just above 18,000. It was about 18,200 when it bottomed out. So it went from 29 to 18. It was scary. Every day in March, I was hoping that the market wouldn't open because we see the pre-openings every morning were so ugly. The stock market halted many times because of huge drops during the day that trigger automatic stops. If you looked at your investment accounts and IRAs, you saw this happening. But if you took appropriate action and were able to keep the emotion out of it, then you probably ended the year in really good shape. Which brings us to today. This year, our panel and I will make our stock picks, and I'll open it up to some Q&A so you can ask the tough questions. So introducing our distinguished panel, beginning with the book cooker. I mean the statistician. Fellow Flint Rotarian and Plant Moran's own resident CPA, Stu Kelly, is in his second year as our statistician. Stu's done an impeccable job keeping compliance off of my back during his first year as our statistician. At the end of the program, I'm requesting that you send your Dow Jones pick to Stu's email this year, stu.kelly@plantmoran.com. I can put that in the comment section when I get a second. Please welcome our statistician, Stu. Stu, wave.
Everybody. Yeah, we'll see. And we'll show our results probably towards the end of the program.
Yeah, I got those. We'll get those in. We'll show them.
Yep.
Ken Schluchter's on year number 7 with the panel. Ken has 26 years investment experience, the previous 6 being at Huntington Bank, where he's currently the senior portfolio manager. He's a 2-time grad, BA and an MBA from University of Michigan in Ann Arbor. In Ken's former life, he was a microbiologist, a computer programmer, and a military pilot. Please welcome Ken. Ken, wave. New on the panel this year, of Putnam Investments, senior regional consultant Dave Fisher is joining us. A native of Michigan and a graduate of the University of Michigan, Dave has been in the investment industry since 2004. Dave has 2 sons, and he had married his high school sweetheart, who's a journalist / news anchor. In his first life, Dave was a professional singer as a tenor, where he sang across North America as a soloist with the Cincinnati, Detroit, Chicago, Philadelphia, Seattle, Toronto, and Naples symphonies, among others. Please welcome Dave Fisher. Dave, wave. One quick note about Dave is I've pulled Dave out of his meeting here. So at 1 o'clock, he's going to have to head out. So just a quick note there. Okay, moving on. Needing no introduction, a graduate of Dart Training School and contemplating a graduate degree from there as well. Dart man Dave Smith. He's the sales manager at Scaff Carpet and Furniture. Dartman was the past president of the Rotary Club of Flint in 1997 to 98 and is consistently Rotary's best dressed. Welcome, Dartman Dave.
Very nice.
I am Nick Godleski, financial advisor at Raymond James. Undergrad from Michigan State University, along with a master's degree from the University of South Florida. I'm currently a board member of the Crim Fitness Foundation, a board member of the Michigan State University Football Players Association, and I am the upright bass player for the Mott College Jazz Combo, currently on COVID hiatus. As for all of you, Rotarians were essentially split when it came to their Dow picks, and the Dow ended up right down the middle of Rotarian picks. Okay, George, can you put that up on the screen? This is the only slide I have for you.
I will try. Hang on.
Usually we hand this out on the table, and so we couldn't do that this year. So there it is. The closest picker was Jessica Sampson of the Flint Institute of Music. She came just 61 points away from the close of the year. Hank Fracolosi won the year previously. So if we ever get a chance, we'll get that trophy over to Jessica. Congratulations, Jessica.
Right.
As for last year's panel, Dan Zimmer, who retired from the panel this year, he came closest to picking at 30,250 with the panel win for the Dow pick. Aside from Dartman, the picks for the Dow were all very close. But as for the individual stock picks of the panel, Ken beat all of us, apparently forecasting that everybody would be spending all their time at Home Depot this year. Home Depot finished up 18.7%. That is 2 years in a row for you, Ken. Congratulations, Ken.
Wow.
Nice.
As for the rest of us, well, the Dart did not predict very well, as Weibo had a 14% drop. Previous panel member, Dan Seymour, he picked Aaron's, which was up 7.5%, right on par there with the Dow gains. And as for me, I did not predict a COVID year that would slam the banks. I will say, I feel I picked a strong bank, a strong gaining bank for the future. But due to COVID, financials were certainly not the space to be sitting in during 2020, as my pick was TCF Bank, which was down almost 17% for the year. But I have to mention that it has gone up 18% since the start of 2021. So I hope you guys didn't sell your TCF holdings on the 31st of December. So now on to our panel and their pick for the Dow and their stock pick for 2020. Starting off, Ken, would you indulge us with your thoughts for 2021?
I certainly will. I'll start off with what we're looking at for the Dow. And I'm going to say I'd probably rather be in small cap and international. I still think the Dow is going to do okay this year. I'm thinking about 5.5%, maybe cash over cash, which works out to somewhere around 7 when you figure in total return. So I'm going to pick a number of 32,290 to end the year. As far as my individual stock pick, I think I'll stay in the home improvement type area. Figure all those people in Home Depot are buying a bunch of cheap tools that are now starting to break as they come into summer. So I'm going to go with Stanley Black & Decker. You're probably familiar with, obviously, a lot of the tools they make, Stanley tools, Black & Decker, obviously. They also make DeWalt, which is what made me think about it, because I've been buying a lot of DeWalt tools lately, replacing the ones that broke over the winter. They also bought Craftsman from Sears, and they make Porter cable. So I'm thinking people are going to start doing things a lot more construction, this infrastructure stuff. They don't just use giant Caterpillar tractors and bulldozers, things like that. There's also a lot of professional tools being used and gone through, and Stanley also has a good international presence, really across the board. Manufacturers are already come back a lot. We're waiting for the service industry to come back. But I think this is relatively a safe and steady pick kind of to go through this year. So that's what I'm going with. It's ticker SWK. Yield's about 1.6 right now, so that's better than you're going to get in anything fixed income without going out 30 years or so. And that's what I'm taking this year.
So on that note, since you said 30 years, I did pull up the 30-year treasury. You're right. Right now it's 1.8% for a 30-year treasury.
Right.
Yuck. And so just for everybody on the panel, so we know, he said there's a yield of 1.6%. So when there's the yield is that dividend. When there's a gain, we add that yield to the gain as a percentage gain as far as we go. So you get credit for that yield, for that dividend. Okay. Dave, our newest panelist, will you please show us the way?
Good morning, everybody. Thank you for the invitation. It's great to see you all. Happy New Year. You look wonderful and healthy, and it's great to be a part of this group. Humbled at the historical precedent being set for this particular event. So thanks for letting me be a part of it. I'm going to be very bullish. I'm going to be very, very bullish. And I'll tell you 3 reasons why. One, with the vaccine rolling out across the country, it's not as fast as we certainly would want it, but our call is that the economy is going to have the best year of growth we've seen in over 20 years in 2021. Why? Because people are going to get back out of their homes and start to travel. Last year, consumers saved more money than they ever have in history. We saw savings rates in 30% in the second quarter. What does that mean? A lot of people across the country are dying to do things and buy things. Home Depot's been certainly a benefit of that over the last year, but as you can think about going back to concerts and baseball games and so forth, this doesn't happen until probably the second half of this year. But when you look at what is embedded in this, we had a very deep recession in the second quarter of last year due to COVID, and we're coming out of it very, very well. And the data is pointing to this. Without getting too technical, I think that puts the Dow, up by about 14% would be my prediction this year, with a closing price around 34,500. The other reason that I'm giving you this number is that this has nothing to do with the opinion of the economy. It's backed by that. We have huge government stimulus coming. There's already some in place. I think if you look at the news coming out of what we're expecting next week after the new administration takes over, last night there was talk about a $2 trillion stimulus. That is supportive of the stock market. The Fed is on hold. The Federal Reserve Bank is going to keep rates low. As Nick mentioned, the 10-year Treasury is just under 1. That's all-time records. They're not even thinking about raising rates. They've said as much. So that's supportive of stocks going higher from here. And the economic backdrop is relevant. But I'd have you all take a look at something called the January effect. The January effect. Just go back to Yale Hirsch, a researcher that says, what happens when in January, so goes the market for the rest of the year? There are 2 measures that Yale Hirsch researched. And one is what happens the first 5 days of the year, the first full trading week of a year in January. And then what happens in returns, once the full month of January is in the books. I can't tell you what stocks are going to do for the full month, but for the first 5 days of the year, the S&P was up about 1.8%. And 82% of the time, when the first 5 days are positive, 82% of the time going back 45 times as has happened, the stock market is up by an average of, guess what, 14.8%. So hence my 15% goal for the Dow, about 34,700. Okay. As for my stock pick, I'm going to go really contrarian as a result of what I've just said in the economy. All I hear about is Tesla, alternative energy, Zoom, Microsoft, the FANG stocks, everything technology. I'm going to go completely contrarian, and I think my favorite stock pick for 2021 is ExxonMobil. I mean, for 3 reasons. Why? How bad and how much worse can the news around ExxonMobil be? Oil is finally back up above 50, but things have been horrible there. Nobody wants anything to do with internal combustion engines. We've all been stuck at home, not driving our cars, not traveling, not getting on planes. I have a feeling ExxonMobil is going to turn it around in 2021. In fact, if you look at what the analysts across Wall Street expect in terms of earnings growth for ExxonMobil, let me give you some perspective. They expect earnings growth for the S&P this year to be up about 20% over earnings last year. ExxonMobil's earnings are expected to be up 500% in 2021 and another 100% in 2022 over this year's earnings. There is a huge cyclical earnings wave coming into energy and oil. And I think if, in fact, we all start to get back after a more normal-looking lifestyle, back on the road, back traveling, back consuming, that will put increasing demand on shrinking supply of oil. That is supportive of ExxonMobil. So my price target, today it's trading just below $50. My price target for Exxon is $75 by the end of the year, which takes it back to its price in about 17, going back a few years, and it's currently yielding 6%. It's a very attractive yield. very contrarian, where there's nothing but bad news around Exxon and oil and all that. I have to think that that the street has sort of kicked this thing to the curb, and there's a lot of upside left. So there's my picks. Thanks very much for the invitation. Nick, take it away.
Dave, Exxon's ticker, XOM.
Correct, XOM.
Yep, and its yield is actually a little higher than probably yesterday. It's just above 7% at the moment. So that's a give me 7. You just got yourself right there. I just wanted to say it was down 36% last year, and it's up 17% already this year. So it's doing what you're
That's
saying.
correct.
Dave, you always bring excellent tidbits. Okay, and on to me. We are in an extremely interesting economy that is, and I know this is way overused, but it's unprecedented. We always look for trends and indicators to figure out where to place our money. 2021 will be about recovery, but what kind of recovery will take place? The Fed has promised to keep interest rates low, just as Dave commented on, which is good for building an economy, but it makes for finding fixed income, what Ken was talking about, extremely stingy and difficult. Gone are the days of 14% bonds that were safe. But the stimulus actions that have taken place should be a boost to the economy, which I would see boosting near the end of the summer, then into the fall. Why do I see this? It looks as if the economy will have a very slow growth in the short term. These first few months of the year will be slow and choppy because we're still trying to figure out how to open back up, get the vaccines distributed and actually given to people. And if all goes as planned, the vaccine should be given to all by Memorial Day, hopefully. This will trigger an opening that will likely accelerate quickly because there's a pent-up demand, especially for services, a rebuild of depleted inventories, an improving labor market, and a resurgent global economy that should help the economy notch its top speed through the summer and early fall. However, towards the end of the year, the US economy will likely reach a steadier stride, finishing at a slower but more sustainable pace. So this leads me to my Dow pick, also relatively bullish. All that being said, I believe there's going to be about a 12% gain in the Dow this year. So I place my number at 34,278. 34,278. And Dave, real quick, you had 34,500, correct?
That's correct.
Okay, I just want to make sure I wrote down that
34,500.
number correctly. Okay, good. All right, so my number is 34,278, just a little bit below what Dave has. As for the stock pick, 2020 was a year for tech stocks. Dave, didn't you just say that?
I did.
If you had invested $10,000 in Zoom at the beginning of 2020 and were lucky enough to sell it in October, then you would have sold it for about $74,000. So a decent rule of thumb is that you don't buy the sector that did extremely well the previous year. The reason for this is that it's now time for another sector of the market to have its time. This is a good rule to live by most of the time, but this is 2021. The economy is changing forever, and I believe it is smart to get into a space that is evolving with this new economy. Ping Identity, P-I-N-G, spelled the same as the golf company, but a different company. They are a modern identity and access management security vendor with a diversified portfolio of identity tools, enabling employees, partners, consumers, Internet of Things devices, access to both on-premise and cloud applications from any device. Ping enables secure access, leveraging its intelligent identity platform to ensure the right user and device is accessing the right service application or API, application programming interface. Ping's suite of solutions include single sign-on, multi-factor authentication, access security, API security, directory, and data governance. Some of Ping's clients include Scott's Miracle-Gro, TIAA, Chevron, HP, and a little up and coming company that goes by the name of Netflix. Ping is a tech company that I believe the combination of favorable secular market trends being in the early innings and poised to accelerate, combined with Ping's differentiated technology in both enterprise scale and increasing customer identity use cases, and proven ability to operate a profitable growth model, make this an attractive asset at a reasonable price relative to the group. It is for this reason that my pick for 2021 is Ping, P-I-N-G, currently trading at $29.72. And I hope to see it about $40 by the end of this year. Dartman, on to you.
Hey, I'm pretty impressed with this, with these very well-educated folks picking and making good predictions about 2021. I'd have to tell you, I'm pretty optimistic myself. But what I'll start off with, in light of my poor performance last year, I want to try and gain a little credibility. So if you'll allow me, I'm going to read from last year's notes, January 17th, 2020. This was my final comment in January 2020. Presidential election year typically means the economy should be propped up at least to look good so no one can blame the incumbent. President Trump, speaking at the UN General Assembly, recently noted, "My economy is the greatest economy in the history of this country, or any country in the universe, and we will get China to pay for it." In fact, the Dow closed at a record high on the news that Trump signed a new trade pact with China, halting a 2-year trade dispute. President Trump noted that the complex deal included an agreement that China would interfere with the next presidential election in his favor. When asked about the rather unusual codicil to the agreement, President Trump said, "What? What are they going to do? Impeach me again?" So I would like to at least take some credit for the unfolding news in 2021. With that note, I'd like to plunge into today's remarks leading up to my stock prediction and my Dow prediction. So this past year, on a personal note, was kind of a roller coaster for my own investments. I accumulated a significant pool of assets early in the year. And then when COVID-19 hit, I could not take back my returnable bottles and cans. This caused a serious cash flow problem exacerbated by an increase in the purchase of various Michigan-made IPAs. This all coincided with an awkward mistiming in my toilet paper investment. 2020 changed many things for many investors. Along with the change in retail shopping, there was a big change in the clothing industry. As more people worked remotely, seen only on Zoom screens, people began working from home in yoga pants, sweatpants, or no pants, which in some regions resulted in a 50% decline in professional attire and created a new standard for casual Friday. Of course, the main change in fashion accessories is the mask, and a whole industry has sprung up. We went from disposable masks to more recently gas masks, made most popular last week. Cloth mask has been created in 1,000 iterations, including those with company logos or colorful designs, or the mildly disturbing smiling faces imprinted on them. Apple is expected to come out with the iMask, which will link your phone for hands-free, muffled conversations. Mask technology is reported to also be able to take your temperature, but does not reveal if you've been drinking, which makes it perfect for the workplace. Since traditional fashion shows have been canceled, Americans are looking elsewhere for tips on what to wear. For example, we are expecting to see a surge in men wearing fur hats with horns. Hat manufacturers are rushing to fill orders, and already we see Wall Street reacting as investors seek alternatives to the traditional haberdasser or insurgents. One of the most important issues in the economy is healthcare. Wall Street analysts are studying whether screen fatigue will become a pre-existing condition. Related health issues like Netflix butt and a new mental health complaint arguing with Alexa are being debated. There are some rumors that for other investment possibilities, there's some rumors that there will be an IPO for QAnon as it goes public. I want you to savor that. Low interest rates may push investors into riskier offerings like Milton Bradley, the home game creator, whose business has been buoyed by many Americans locked at home. New games in the planning are Guess My COVID Symptoms, Spin the Vaccination Needle, and a mystery game patterned after the clue board game called Who Kidnapped the Governor, and a fantasy card game called Coup d'etat. In politics, the market is holding its breath as we wait to see how many billions can be poured into bailing out the struggling barista and busboy economy. Also, because next week we are scheduled to see the peaceful transfer of power in the inauguration of a new president. However, as my fellow prognosticators have often said, past performance is no guarantee of future results. So, with that note, we will go on and choose my stock pick and my Dow from the dart. So I'm gonna have to turn the, so you can see this is completely, it is authentic. I'll turn it down here. You can see the photo, 1 second. Make sure you're all able to see that. Yeah, okay, here we go. You see me?
Yep.
All right, here we are. We'll start with the Dow, if you're ready. Oh, not good. I think some of you may want to sell now. I hit 4,000.
Can you repeat that?
Of course, it's 24,000.
Whoa.
Ooh, whoa.
Okay, now my stock pick.
Did you hit the right target?
Give him a mulligan.
Give him a Reggie.
Hey.
Okay, for the stock pick, we hit Novartis, Novartis. I can't tell you now what it's trading at, but I'll refer that over to the other investors.
Do you have the ticker for that one?
Hang on, I'll get it.
NVS, Nick.
NVS.
Oh, from Switzerland.
That's what I thought. Yeah. That was the one I was aiming for. Was the one from Switzerland.
Yeah. So Novartis is a large cap drug company. They manufacture healthcare products through two segments: innovative medicines and Sandoz. I don't know what that is. And it generates a vast majority of its revenue from innovative medicines segment, consisting global business franchise in oncology, ophthalmology, neuroscience, immunology. I think you'll be okay.
I think it's okay. I'm glad you like it.
Hey, David, I took your temperature from your forehead and it came out 0.
Well, it means there's great room for improvement, Reg. I would invest in me for the coming year.
I would invest in new batteries, Reg.
Who said that?
Robert. Okay, so now on to our panel Q&A. This is Rotary's opportunity to question the panel on why your IRA isn't as much as you think it should be, or I guess anything else you'd like to ask. As we've attempted in previous Zoom Rotaries, I'm going to do my best by taking questions. So raise your hand. I'll attempt to call on you. I'll do my best to catch everybody and be fair about it. Dave said he'll stick around as long as he can, but he might have to duck out a bit early. Also, please remember to send your Dow Jones pick to Stu Kelly's email, stu.kelly@plantmoran.com. Stu, can I just have you put that in the comment section there? Okay, but first, I will start off with a ceremonial first question. All right, fellas, are you ready? The question is, the Dow went up about 1.5% on January 6th, the day of the Capitol mob. and then another percent the day after, what would you contribute to the immediate gains during that specific 2-day strange time of turmoil? So that's open to all of you guys there.
Well, Nick, this is Dave Fisher. I would venture a guess that the uncertainty around the outcome of the Georgia election had been solved by the 6th, and with the Senate, House, and presidency now in Democratic hands beginning next week, I think the market was discounting this massive stimulus bill that Joe Biden announced last night. And I think what you see there is with low rates and very little alternatives for investments in bonds, the stock market says, look, this is going to be supportive of this growing economy, this cyclical move higher for economic expansion in the second half of 2022. And was sort of, the market doesn't react on current news. It's looking way down the road. In fact, the move we've seen from last March, the lows of March, would tell you that the market was already saying we think the economy is going to come back out of this COVID mess. And I think you just got a little bit more of that on the 6th and 7th of January with more government support on the way.
Yeah, I saw it as some confidence in the market, just knowing what's going to be.
Absolutely.
And so.
And I saw it as confidence in our government. We would get through this mess that was that day. That was terrible. It was outrageous, but I have confidence, and I think most people did, that as a country, we will get through this mess.
Other questions from the Rotarians? Raise your hand. I'll try my best to call on you. Or Joel Fike. I'm Joel Fike. I have a question, right?
Yes, I do.
All right, go ahead, Joel.
Biden's big plan that he announced is going to cost money, a lot of money, that will be put onto the deficit for regular folks, as you like to call it, the people on Main Street. Does it matter that the deficit is going to get so much bigger to pay for all this?
I'll give you a start here on that question, because I kind of asked a similar question to The Economist back last month at the forum. That's the part that I struggle with the most, is what's the very real long-term effect of this kind of debt? And it might not be a negative thing at all. What my best understanding is that money's directly into the pockets of individuals is going to have a better short and long-term effect than government long-term debt. That's my 2 cents on that.
Yeah, I'd argue
it's a lot of money.
It's a lot of money in the face of the challenge we've all been through the last year, give or take, with COVID and so forth. It will stand to be more support, right, for the economy getting back on its feet. So the near-term consequence isn't particularly dangerous, we don't think. But the long-term thing you can't really argue. What we were calling for, along with other things, that we think this kind of debt and this kind of new money liquidity in the system likely brings, is a continuing weakening dollar internationally. We will feel that, we would think, down the road with potential for inflation. We don't see inflation this year as a big risk. Mm-hmm. But you can see in global markets, the dollar has weakened quite a bit in the last few months. That probably will continue as a result of this type of debt accumulation under the balance sheet of the country. That also provides more opportunities for investments overseas, which we haven't really seen in a long, long time. But the long-term implications of heavy 100-200% debt to GDP, we have at least a year's worth of debt longstanding in the economy. I'm just talking about treasuries that we could potentially produce in the overall U.S. economy. You get much above that for a long period of time, and it tends to slow things down. So this is a longer term thing to be thinking about for 2021. It's important. Our government's the lender of last resort, trying to prop up the economy that's been so damaged by COVID.
There's a lot of economists right now, some new way of thinking. I wish I remember the name of the school, but I don't. That basically say that you don't have to worry about deficit spending. You can rack up all the debt you want to as a government, as long as it's not inflationary. Now, to me, this sounds like basically a free lunch, but that's a lot of the thinking say this really doesn't have that big of an effect, especially with an interest rate environment like this. You can borrow money for 30 years at 1.5%. there better be some things you can invest in that's going to return more than 1.5% over 30 years. So that's some of the thinking also.
Amen.
Next question. Any, Dick Schick.
Kyle has one.
And then, okay, I'm gonna go Dick Schick, Kyle, and then
Yeah,
Bill Mack.
I'll defer to Dick. I'll defer to Dick for sure on this one, Elder.
Oh, he's muted. Hang on.
Unmute.
There. Jesus.
Can I go now?
There you go.
My concern is about China and what China continues to do and has done. They wiped out Hong Kong's democracy.
Oh, yeah.
They're going after Taiwan next. They've been expanding in the South China Sea. And they obviously have indicated strongly that they want to be stronger economically and militarily than the United States of America. And if Xi Jinping continues down this road, which I think he will do rather strongly, I have marked concerns about the new administration and how they're going to handle that kind of a problem that I think they will be presented with within the next 12 months rather strongly.
China's a tough one. Go ahead, Ken.
Being a former Navy guy, of course, the way I look at it, the growth of the Chinese Navy is almost remarkable right now. And that's certainly a concern throughout the region. The de facto deal we have with Taiwan of defending them, and then it's not going to be that far in the distance where we have to kind of wonder if we'd actually be able to. And this doesn't affect us, it's also affecting Japan. I mean, Japan's making destroyers now that are 500 feet and just happen to carry aircraft, even though they constitutionally can't have aircraft carriers. So how that could lead to a buildup in the east, the pivot we started a long time ago with pivoting our defense structure to the west, to the far east, is going to have to continue. But it's certainly something worth keeping an eye on. I mean, the things they produce are still inferior to ours in a lot of ways. We still have our advantage in aircraft, and you can't build a Navy and then have it perform like the British or us or the French or the Russians in 10 years. So it's certainly a concern. But, you know, there's such a dynamic there that you really don't know what it's going to be like in 5 years.
Kyle.
Yeah, thanks, Nick. It seems like the market last year, and I think a lot of the folks on the panel today are predicting largely a V shape or maybe Nike swoosh a little bit longer term, but general comeback for the economy. But I'm thinking that some sectors won't come back the same or will be affected by permanent changes in our just way of living. For me, commercial real estate is one that comes to mind, kind of more in a K-shape recovery for the economy. And just wondering if there's other sectors along with commercial real estate that you think will either not bounce back the same or bounce back in a much longer time horizon than the rest of the economy.
Yeah, I like your real estate comment there. Commercial real estate's probably going to get flipped a little bit. It's bizarre. I mean, I literally haven't been in my office since March, and I haven't had an absolute requirement to be there because I have all the technology right here. I'm going to go ahead and just call Dave Fisher out and disagree with you a little bit, Dave. I think energy is going to get just smoked unless they're really turning it around to be a different type of energy, which is what needs to happen for them to be long-term sustainable. I don't see real estate being a positive thing. And then consumer staples might have a little bit of a trouble there, but like IT, healthcare, consumer discretionary like Home Depot, McDonald's, Nike, communication services like Verizon. I see those just really sitting on top and staying strong for a long time. And they're set up for long term.
Question I get a lot around those lines is on airlines and business travel, saying why are people going to be traveling for business once this breaks free, just, you know, because you can do a Zoom meeting. But, you know, they probably said the same thing when you made, you know, they then came out with telephones saying, why would we have any kind of meetings at all when we just call each other up? So it remains to be seen how that's going to come out. And And to defend Dave a little bit, my pick just before I went to Stanley Black Decker was Chevron. I was going to go with that also because it's a 1-year contest. I wouldn't pick them over 10 years, but
Yeah.
Especially international emerging markets, when they start using oil more, it's still, everybody would love to have an electric charged car, but you can't carry around 5 gallons of electricity when you're going through the deserts in Nairobi.
I'd offer 2 thoughts on this. And one thing we can all keep in mind is that it's not different this time, but what is different right now is that we have not had a recession in the United States since 2009. And the really quick thing to think about is for the last dozen years, up and through March, our economy's been floating along at 1 to call it 2.5% growth. Call it a muddle through reality. No recession, but just sort of very slow growth for the long term. And that is a market that favors technology, or more importantly, high growth stocks. When the economy isn't delivering big tailwinds to a lot of sectors, investors want to look to the companies that are getting it done anyway. And that's been a perfect setup for Amazon, for Apple, think of your iPhone, for Microsoft, the companies that are delivering very clearly high quality earnings and growth, despite an economy that's sort of muddling through. Then we come into 2020 and the virus takes hold, and we have this huge, really the fastest bear market in the S&P, the fastest drop in economic data, the highest unemployment rates ever published since, records have been started. And what happens when you go into a recession, you get into the teeth of a recession, those same growth companies get even more favorable as investments while we sort of tank on the economy. And that's exactly what has happened the last dozen years or so. We think at Putnam, the recession ended in August or September. And in fact, the market looked ahead of that. So at the end of March, you saw this massive comeback in the stock market through last year. What's different right now is that when economies are coming out of deep troughs, the investment theory and philosophy and the leaders in the market change. And we really haven't had a leadership change in the stock market for a dozen years until about 3 months ago. And companies that tend to benefit from growth in the economy, energy, financials, and some extent staples, right? Or utilities even. When the economy is giving that big tailwind boost to the companies that don't do well in a muddle through, you start to see stock and dollars, so forth, rotate to those companies. And that's exactly what we've seen happen in the last, call it since September. Value stocks have led growth stocks. Large cap stocks have actually trailed small cap stocks. Small caps have led since September. And companies like Exxon and JP Morgan, the big bank, which benefits from a growing economy, had record earnings last night that were announced. These more traditional cyclical companies, we think will lead through 2021. It's just text. It's not my opinion. It's just sort of what happens when you come out of a recession. If you look back to history, this has been a traditional plan and a traditional way that the stock market works. You add low rates to that equation, and we see probably a faster growth rate than would otherwise mentioned. But to Kyle's point, there are sectors that are going to take a lot longer than a year, 2 or 3 to recover from where they were, if they're not just totally remade. Real estate leads that group. Travel and leisure lead the group. They're going to be probably quicker than real estate. But you have to have people, if you think about it, all of us in this room have to be able to be together and be able to convene and congregate again and be comfortable doing that before things like real estate, travel, planes, and so forth become commonplace as they were, call it 10, 12 months ago. So anyway, that's my 2 cents before I have to go back to a Putnam meeting. But I hope it helps. You're in great hands with Nick, some wonderful people. It's great to meet you all. I'll stick around as long as I can. As soon as I get the ping, I'll jump off. But thank you guys for the invite. Happy New Year.
Thank you, Dave.
Bill Beck, you're next on the list here, Dr. Beck.
Yeah, I just had a question just sitting here in my mind, and I may be off a little bit on the numbers. In roughly 2008, the national debt was approximately $9.5 trillion. It's now in the $23.5, $24 trillion range, and maybe a little more, especially with the 2 more trillion they're talking about. That's almost a triple in about 12 years. Where do we go, and how do we deal with a doubling or a tripling in the next 12 years? When are we just totally broke? Or are we ever?
Bill, it's certainly not a simple question that you can just answer off the top of your head. I mean, we're still as a percentage of GDP behind a lot of countries as far as total debt.
Yeah.
But you can argue that that's why Japan's been stagnating for so long, because their GDP, I don't remember the number off the top of my head, it's like 2 times the national debt's like 260% of their GDP or something like that. So you kind of wonder if stagnation, there's a lot of other reasons for that also.
Sure.
But we're still, even with this, and I'm
I
not
think-
saying it's a good thing to be where Greece and Italy are as far as their debt is, but you can argue that there's still room for more debt.
Okay.
Yeah, we're not killing it on inflation like you were talking about before there, Ken. Part of it is that's different from even the 2008, 2009 time period is the economic recovery attempts by the government has started way earlier this time than last time. And then what's happening now politically is Biden's putting the same people in the same spaces that were in charge of the previous recovery. So these people have done it in a different realm, but they've done it, they've seen it. So hopefully that can be a benefit down the line. That's a tough question though. You're absolutely right. I mean, I don't have the answer to that one. How much debt can we hang on to like that? I do agree with Ken though, that it's kind of just a number on paper right now. We don't know what it's going to look like, and there is probably still some room.
Yeah, I guess the question becomes, when does it not become just a number on paper? I know it's hard to answer.
Yeah, I don't have that answer for you. That's those really smart economists that work for Mr. Helmuth over there. Next, do we got a hand up there?
Yes, I have a very sad message for the Rotary Club. We were just called. Michael Lindeman passed away last night.
Oh, no.
Mike.
Oh, sorry.
You can go online and see his obituary. And his daughter-in-law is going to send that to me on my computer so I can provide that to Ray Gist or who would like to have that information.
I'd like it.
Thanks. Thanks, Dave.
Pretty young man.
Appreciate it.
Yep.
Wow.
He struggled for more than a year.
Mhm.
They gave him 6 months, almost a year ago, and he lasted way beyond that time. And he's taken it very well. I talk to him every so often. And it's hard to lose a good friend.
Yeah.
No doubt about it.
When I'm through here, I'll go online and get that message from his daughter-in-law and give it to Ray Gist.
Good. Okay. Let me know. Thank you.
Yeah. Who's up? Is that it? Oh, Mr. Saab, Gassan.
Thank you, Nick. And first, sorry about your loss and our loss, Richard. That's terrible news. If I may go back to the deficit subject, or are we past that?
Nope, go ahead.
Okay.
You might not get a great answer.
Yeah. Paul Krugman, who is a Nobel laureate in economics and a writer at New York Times, he says the fact that the dire predictions of deficit goals never came true, and there is now widespread agreement among economists that debt is far less of a problem than conventional wisdom asserted. Among other things, while the level of federal debt may seem high, low interest rates mean that the burden of servicing that debt is actually very low by historical standard, which is consistent with what we just heard, that we still can afford more debt. So he's giving advice to Biden: don't worry about the debt and go forth with what programs you think will help with the COVID and the economy. I would recommend his whole article. He has 4 rules that he's recommending to the new administration in dealing with the economy. The debt was just one of them.
Did that just come out today?
It's in today's New York Times.
Okay, gotcha. All right, anybody else? I'm doing my look around. Yell to me if you got something. All right. Mr. Gist, I think I'll hand it back off.
All right.
Can I make one last comment? Michael's funeral will be Sunday, and it will be online. So you'll be able to see that.
Okay. Okay, Dick, thank you.
You bet.
Gentlemen, the Rotary Club of Flint appreciates the time and preparation that you donated for your very enriching presentation. And we will look forward to seeing you again next year to gain even more enhancements to our portfolios. We will even use the same brand of darts. We thank you for joining us today. Thank you very much.
Ray, let me add in here because Jane just asked, are we supposed to send our predictions to Stu? Yes, send your predictions to stu.kelly@plantmoran.com.
Okay.
And if you send them a day late, you're cheating.
I actually had the thought if we send it out like in our next newsletter, but by then, like we're weeks
today.
behind. That is
Today.
yeah.
Reg.
I thought a day before.
Everybody.
I thought a day before this next meeting, or a year from now.
Exactly. Yeah.
Right. I want to thank Lonnie Maxwell Cook, our Rotarian, for his very inspirational message, and I thank our note taker as well. Flint Rotary thanks each and every one of you for joining us today. I hope you enjoyed our program as much as we enjoyed welcoming you as members and guests. Please join us next Friday for our program featuring Dr. Jan Furman and Dr. Tom Bell of the University of Michigan Flint Urban Institute for Racial, Economic, and Environmental Justice. Stay safe, keep warm, and look to open opportunities in order to provide service above self. We are adjourned.
Everybody, have a good week.
Thanks, and
Ready?
same to all of you.
Good job. Good job, everyone.
Very good.
Yes, very enjoyable.
Excellent.
We'll all come back with full pockets.
Amen.
I hope so. Nice job, everyone.
I agree. Thank you. See you next week. Might even bring some sunshine.
I hope so.